About 670 stocks, 1,000 stocks are lower and 670 stocks are higher at this point in time. Well, you got, what, the heat map is on, right? 12 odd names which are higher, and I can spot Infosys there. Infosys is in the green. Bajaj Finance, of course, is the top gainer, followed by Kotak. On the other end, you've got NTPC, ONGC, and Tata Motors passenger vehicle business, which is lower. But it's a flat start, 40 points lower on the Nifty. But let's go wider with the broader markets. Nigel, take it away.
Well, that's right, Prashant. As you said, the Indian markets have started lower. But as we were chatting about earlier today, maybe, in fact, India's time has come. And hopefully we outperform from here on. And at least the initial signs are that things are not looking so bad. As you can see, the Nifty Bank, the Sensex, all of them in the red. But actually, the Nifty Bank, that's the one that's actually come off considerably from the lows of the day. But that's the number you want to track, the 600 or 700 stocks that are currently higher in trade. By the end of today, if that number can move closer to around, 1,000, 1,200 odd, your portfolio will be feeling quite good. Let's run you through a few names, though, that are moving around. Metals have come in for profit taking. That's been the outperformer in January, as well as the initial part of February. But that one's come in for some selling. So Hindustan Zinc, because of the silver exposure, that's lower. Vedanta is the parent of Hindustan Zinc, so that as well has seen some profit taking. While Hindustan Copper as well as Nalco, there has been some kind of profit taking on copper as well as aluminium prices, though it appears the trend is still up, going by the demand-supply situation. So all those stocks are a little bit lower in trade. Some other stocks from the tech space, Hexaware, it was down at 6% yesterday. It's down another 10% today. So massive selling is what we're seeing on that particular name, and a couple of earnings reactions as well. Whether you look at Keynes Technology, we spoke to the management earlier today. They're saying Q4 is going to be super. The street is asking, why didn't you alert us that Q3 is going to be so weak? That stock is down 5.5%, and yes, it was down 5% as well going into its numbers. Krishna Diagnostics, that's the other stock that in fact is lower in trade today. That as well is down close to around 4.5%. Page Industry is not keeping it very, very brief. That one came out with its set of numbers. It appears there is some profit taking on that name as well. It's down close to around 2.5%. NCC, the stock has halved from the recent peak. Order book looks pretty good. Execution is going to be tracked from here on. But for the time being, the stock is down close to around 3%. But it's not all gloom and doom. It's a Friday, and there are some freaky stocks that are doing pretty well. Hitachi Energy. In a short while from now, we'll have Mr. Venu who will be joining to detail those numbers. Boom, up close to around 10% in this market. Nykaa. Mangalam is telling us there are some upgrades that are coming in there, 3.5% higher on that particular name. And Data Patterns as well as a stock that's doing quite well. There was one big order win that we got for a smaller company, Talbros. I think that stock as well should come up for you. So there are a fair bit of stocks that are actually in the green in today's trading session. The Nifty, it's still down close to around 20 points. But you take a look at global markets and you'll say, hey, it's not so bad. The Nifty actually is doing pretty well today. But that's the number I'm going to track. 722 stocks advancing. By the end of today, I'll tell you what, 1,200 stocks is what I'm hoping for. Let's see how it goes. Rima, back to you.
The small cap index, Nigel, is down nearly 1%, and the IT index, the Nifty IT index, also lower by 1%, taking its weekly loss now to 6%. And the silver ETFs are selling off, and selling off hard now. Look at Growth Silver ETF, SBI, HDFC Silver ETF, Tata, Nippon. Across the board, you can see a sell-off commensurate with the kind of volatility and decline we've seen in silver prices. So that is hurting. On the way up, you've got some moves in stocks like G&G Electronics, IGI. These are some names which deserve mention. LIC too is moving up 4.5% post the numbers. Optically, they look good, but Yash was telling us margins need greater scrutiny. But let's invite Manishi Ray Chaudhary, CEO of Emma Capital Partners, on the show now. Manishi, thank you very much for joining in. Week to week, from Friday's close to today, we're still up close to about 300 points on the Nifty, but we've seen some wild swings. On Sunday, we were down 500 points. On Tuesday, at one point, we were up 1,200 points, but we ended up in the green with a gain of about 600 points. Your assessment of the markets, and also considering the kind of weakness that we're seeing in the U.S. markets, and particularly tech names, where are we headed?
Right. Thank you very much for having me. This volatility that you are talking about, it is partly generated by, this unprecedented degree of, uncertainty that we're seeing across the world. We're seeing that in the United States. We're seeing that across Asia. And there are quite a few factors that have kind of combined together, that have come across together. We have seen uncertainty about the sustainability of AI CapEx being talked about. Just look at the reaction to Amazon's $200 billion capex announcement yesterday. We have seen the uncertainty about it, how the new Fed chairman, Kevin Walsh, would actually handle the monetary policy going forward. We have seen a degree of uncertainty as a consequence about the dollar and therefore bullion, the kind of reaction that we're seeing in gold and silver. So it's rare that you have so many variables that one has to juggle with in such a short span of time. In fact, if you talked about this Friday to Friday last 1 week's movement, India has actually been relatively stable. If you look at just that one week period. In contrast, Hong Kong, China, Korea in particular, they're down anywhere between 7 to 8% during this period. I think partly there is a degree of good news that have come across for the Indian market. Even though we don't know too many details about the trade deal at this point of time, it has done its bit in terms of trying to improve the sentiment, not just about the equity market, but also about the currency. So, yeah, I mean, I would possibly be a bit more positive about India. It would obviously help, if we do get to hear more details about the exact contours of the trade deal.
Manishi, so where would you be focused on? I mean, if this is, we had Pankaj Tibrewal yesterday, right? He's very much here. He's gone on, met companies, and he's looked at the third quarter numbers so far. Guess what? Small cap, some 200 companies were reported there. Earnings growth is 39%. I mean, some resource companies perhaps are outliers and the numbers have been pushed up, but generally it's pretty healthy, right? And he's saying, well, actually, companies are sounding a lot more positive for some reason, mid-December onwards. So if there's a disconnect, where would you look to exploit that discrepancy in terms of opportunities?
Well, I would definitely look at those sectors where we are beginning to see some degree of earnings estimate upgrades. They're very difficult to find in India. There are some in basic materials, the base metal companies where earnings estimates are moving up and the sector is still relatively cheap. There are a few in industrials. We have seen even the government policy pivoting back to industrials and investments from consumption. I would, still be selectively positive on consumer discretionaries. At some point, the massive fiscal stimulus that we saw in 2025 would begin to have some impact on demand. We also have adequate room for the Reserve Bank of India to cut rates more. It may not happen today, but it'll eventually happen over the next 6 months to 9 months. So if I put all these things together, I would be possible. Also, I forgot to mention the banks. In fact, if you do a usual price to book versus ROE, kind of a scatter plot, financials, basic materials, they would be on the bottom of the list. So they are the relatively cheaper compared to their fundamentals. So I would definitely be positive on financials. I would be positive on base metals, basic materials. I would be positive on industrials and consumer discretionaries, but those last two sectors, one has to be a bit selective because of the sky-high valuations that prevail over there.
All right. Hi, Manishi. Good to see you in. Manishi, what about tech? Tech is, seeing a sharp correction, a sharp pullback.
Right.
At various times I've seen in the past that some of these fears sometimes don't play out. And they're very well-run companies. Do you think this time the fear is real and actually it could hit these companies? Or do you think, in fact, they're providing a buying opportunity?
As I've said before, that I'm fundamentally very cautious on Indian tech, particularly the IT service companies. I don't have a single one of them. No emphasis, no TCS in my model portfolio. And what we're seeing now is basically that classic AI loser theme playing out. Not just in Indian IT, but across the world. All these, the so-called service providers, their businesses could get disrupted by the new product offerings that are coming in from the LLMs. And this is just the beginning. I mean, we're going to see refinement of those product offerings. We're going to see more offerings which would actually make the job of the service providers a lot easier. So only those companies which reinvent themselves, which possibly are able to use AI to improve their workforce capability and margins and productivity significantly, those are the ones that would survive. And as of now, I don't really see such impetus from any of the Indian IT service companies, unfortunately.
Manishi, you owned, your emerging market portfolio has investments in Hong Kong, China. You liked many of these AI trades as well. What are you doing with that holding? How has it changed?
Right. So, as far as the AI trade is concerned, and thank you for asking me that question, we are basically in favor of the so-called picks and shovels companies, which are enabling this massive AI capex infrastructure. You have TSMC, you have Samsung Electronics and SK Hynix in Korea. You have several others. You have some of these semiconductor companies in China as well. But what we're really focused on are the monopolies and the near monopolies. Think about it. I mean, a deep learning or an LLM, which may not choose to go with NVIDIA's chips, and suppose it considers someone else's chips, like say Google TPU. Whichever logic chips they focus on, it'll have to be manufactured, it'll have to be fabricated at TSMC's fabs. You can't do without high bandwidth memory. There's virtually 2 companies and maybe potentially 3 who are manufacturing them. You have SK Hynix, which has a commanding market share. Samsung is getting there, and you have Micron in the memory space. But some of these companies, SK Hynix, Samsung, they're virtually no-brainers. They're near monopolies at this point of time. So that is basically our focus as far as the AI trade is concerned. There are some adopters in China who are actually increasing their productivity significantly by using AI. Tencent, for example, is an important example in that regard. We are seeing that with Alibaba as well, even though there are concerns about massive investments that it's doing, therefore hurting its cash flows. But yes, broadly, many of these AI plays, they're concentrated in North Asia. They're in China, they're in Taiwan, they're in Korea. And I think that is something India has suffered from, not having those, adequately prominent AI plays.
Indeed. Manishi, great chatting with you. Thank you very much for joining in on Indian IT. He doesn't hold anything in his portfolio, and he continues to maintain Indian IT is an AI loser. But let's now invite the management of Hitachi Energy. The stock is surging in trade now, and they reported a good set of Q3 numbers. Company's top line went up by 29%, profits went up 80%, margin expansion. And Venu, MD and CEO of Hitachi Energy, is now joining in. Thank you very much for joining in. Let me begin with the margin question. Margins at 16.6%, and this is the second consecutive quarter of mid-teen margins. Can you sustain, what led to it, and can you sustain it? Say, can 15% be the new floor for margins?
No, good morning, and thank you for having me in your show. And let me just take a 30 seconds to demystify our results, as we have been consistently saying this for the last several quarters, in fact, several years in your own channel, that we have been building the organization in more sustainable and profitable growth mode. And we have been looking at various segments, not only a transmission, but transmission industries, data center, and service and digital. And all those things, efforts of last several years, several quarters, is what you can see today in that. And we have been saying that what we maintain is a double-digit operational EBITDA, and that's what we have been doing it with that. And our revenues are growing because we have a huge order backlog of close to 30,000 crores order backlog, and then we are able to convert those into revenues. And as many of our customers are looking forward for our equipment and our projects, and then we are able to do that. And the offshoot of all that is the margin. And as I said, we maintain the double digit. I won't say whether it is 15 or 16 or 12, but double digit, all that, we're going to have that.
Okay, but low or mid or high? Give us some indication.
No, we don't give any forward-looking information. All that we can say is that we maintain the double-digit EBITDA margin.
Okay, Mr. Venu, I'll just stick with just one more question on that margin before we move on. Good morning, Prashant here, and congratulations.
Good morning, Prashant.
The commodity price inflation is another level, right?
Yes, absolutely.
So how does this work for you, sir?
I think fortunately this is also part of our strategic focus for the last several quarters, several previous years. We continue to focus on having a price variation clauses fixed in our contracts. As we speak today, more than 70% of our portfolio is having a price escalation clauses. So
flexible price.
We don't benefit and we don't lose either prices going up and down. So we very transparently pass on those things to our customers in that. So from that standpoint, I think we are okay, managing the rest of the portion of the portfolio which does not have the price variation.
So this is all. I mean, basically, you can work around these things, right?
Absolutely.
The other point is this news that Chinese companies may be allowed. That Press Note 3, being put on the sidelines and them being allowed to participate in tenders. Power, of course, is a big area. They were very active in 10, 15 years back. Is that a risk?
No, I think definitely it's a risk, but what we are looking at and what we are also hearing from the authorities that they're not allowing, they may not allow directly imports. If somebody has a manufacturing setup in India, probably that could be an option there. But what we are looking at is, we are looking at a level playing field. As long as the level playing field.
Mr. Venu, sorry, there is one company with a large manufacturing base in India. But that's not.
I don't think that's a material in my view. I don't think that's a material.
But they are in the same space. They're in the same space, like in terms of the product range that you were in.
It will be, but the demand is so much, but just having another one more factory, even if they have a 30,000 MVA capacity, other things is not going to tilt the
change too much. Got it.
Competition and all again. Otherwise, also we are saying all we are looking at is the level playing field. As long as the level playing field is there, we are absolutely okay to compete with anyone. Whether it's the Chinese, Koreans, or anyone.
All right.
So we have built up our ecosystem, especially our supply chains, because we have done a lot of localization here. And today, more than 80% of what we produce globally, we produce locally here, and that's going to be our strength going forward.
All right. Hi, Mr. Venu. Good morning. Good to see you, Ben. Second time in a week. Wow. We thank our staff.
Good morning.
Good to see you, sir. Prior to everyone talking about HVDC, you were one of the people who were going on making those comments on HVDC. And now we know what a big opportunity it is. Now, with the last few interactions, you have been talking about this data center opportunity. And I've been noticing that some of your peer groups, whether it's Siemens or the others, they are not viewing it as such a big opportunity. So could you tell us how big an opportunity it is for you? I think the last time around you hinted that maybe it could be 10 to 15% of the total data center capex that is there on offer in terms of a target market for you. So could you quantify it? What is the opportunity for a company like Hitachi? And from there, how much can you get?
Yeah. So absolutely. In fact, I talked to data center when you came to our factory first time into Bangalore 21 or 22. That time we didn't have a visibility. We didn't have the pipeline of the HVDC. But we strongly believe that, to manage the complexity arising out of such a large scale, grid, you need to have the HVDC built in that, and you can see the pipeline and the order inflows. Data center is absolutely is another big area where we have been consistently saying on that, especially on the air-ready data centers, needs a huge amount of energy, and not only the huge amount of energy, it also need to have flexibility around that. For example, air-ready data centers, so they go from 100 megawatt to 250 megawatt in seconds. So you need to have that kind of flexibility grids built around to take care of the spikes arising out of the thing in that. A query on a chat GPT needs 6 to 8 times more energy compared to in a Google search on that. So that's the power of the AI, and it's like it can work both ways. The AI can also optimize the energy systems, and more energy is required for creating the more AI-ready data centers in that. So coming back to our opportunities, it is actually in India, it is evolving it, especially in the AI-ready data centers are just going to come in. in the world-wise today, the AI-ready data centers, 90% of them are located in the two countries, US and China in that. And definitely India is going to play a major role in that. And this budget providing, tax holiday up to 2047 for using, Indian-made data centers will definitely
Right.
create a more demand on that. From our standpoint, we create an end-to-end, we have the power system studies for that. We have the grid connection. We have also, our technologies will take care of the of these kind of sinks.
Yeah.
And roughly around anywhere between 10 to 15%, depending upon that, of data center capex is our addressable market. And
Mr. Venu, there is this new chip, right? I'm sure you've read about it. NVIDIA's, I think it's called Vera Rubin chip.
Yes.
So
yes.
That's like a breakthrough. That basically means, at least that's what they're claiming right now, that you can cool these chips into these data centers at 45-degree temperature, water. So the temperature at which water is supplied. So you don't need to. I mean, if that is true, I mean that is revolutionary, right? All kind of estimates will change then. You don't need that much. I mean, this power demand thesis because of data center, it'll all change. But we'll have to see if it really works, right? You'd agree?
It might, absolutely. It might. It definitely not going to be 8 to 10 times, and it will somewhere fall in. There will be some disruption.
Yeah.
There will be some new things in that. But even assuming that it would take a factor of that, the need for the data
is huge. Yes.
In India, and that's where we are betting on that, and we are creating our supply chains in anticipation of this demand.
Got it. Mr. Venu, we had many more questions, all of us, but we're out of time. There's the RBI policy, so we're on a clock here. Thank you for joining us. Good luck, and really appreciate it. Uno Minda is the next management we're speaking with on the program. They reported an inline set of third-quarter numbers, and let's get them in terms of the numbers and, of course, the outlook as well. Sunil Bora is Group CFO, Uno Minda. Sunil, good morning. Great to have you with us here. Thanks for joining us. I have to start with this India-US and India-EU. The FTAs, the FTA with the EU, and of course this deal with the US. In what way does this change things for the Indian autocom sector, and what is the tangible kind of benefit that you see?
So Prashant, you are right. In terms of both the FTAs with EU and US, definitely opens up a lot of opportunities for exports from India. We have been seeing that a lot of the auto component players like us have been exporting to EU and US. And now with this stability in terms of tariffs and clarity, and also tariffs going down, definitely it will open up a lot of opportunities. Like, for example, we have also been in discussion with some of our customers, but because of some of these tariff situations, things have not been progressing as one would have expected. But definitely once now we have this clarity, things will speed up, and it will definitely open up a lot of opportunities for exports of auto and auto components.
Sunil, 20% top-line growth, but recently when we look at the auto sales numbers, it looks like the entry-level cars have done better, and that impacts the value proposition for yours. Yours is a premiumization play. What should we expect in terms of volume, value growth going forward?
No, definitely, you are right in terms of the vehicles being sold. Definitely with the GST cut, it was expected as well that it will trigger more entry-level two-wheelers and four-wheeler sale to be more, and that's what the data actually has been suggesting. Because there your kit value obviously is lesser in the entry car versus a premium car or a premium bike or whatever it is. Having said that, there has been change in terms of the adaptation of a lot of these premium features. So as the cost goes down, as the volume increases, even these premium features, which say, for example, used to be in D segment cars or a 350cc bike or a 250cc bike, they've been coming down to B segment, C segment, etc. So the adaptation has been increasing. For example, like airbags. Airbags used to be like penetration was very less. Now it has been consistently increasing. Same goes for alloy wheel and some of the lights. So as we move forward, we do expect this premiumization play even to get into some of these entry-level cars. May not be in the base models or base models of the two-wheelers, but definitely in terms of the upper models of those same segments. So as we move forward, we do expect this momentum to continue. As you know, we have been significantly expanding in terms of our product profile as well, and building our capacities in line with our customers. So we are pretty confident that this growth momentum definitely will continue. We'll not be able to give you actual growth numbers because we don't normally talk about the OE1, but definitely our endeavor has consistently been on an annual basis, whatever industry grows, we consistently grow at least 1.5 times or more. And we're pretty confident that we should be able to deliver that.
Hi, Mr. Bora. Good to see you in, sir. And, hoping business is doing pretty okay. That said, how do you see the business evolve from here on? If you tell us the content per vehicle that you're dealing with currently, both two-wheelers as well as four-wheelers, and how do you see that number scale up? Give us a broader time horizon, say in the next 12 months as well as 24 months. How do you see this improve? Because you have been hinting about this in the past.
Yeah. So, Nigel, there are some of the products which currently are in the development phase, which gets into the production phase somewhere in the next calendar year. If, for example, sunroof will get into production next year, some of the EV components for four-wheelers will get into next year, some of the two-wheeler EV components also will get into the next fiscal year. There are a lot of these products which will get into SOP in end of 27 and early 27. So this consistently will help us improve our offering into per vehicle, which will actually translate into the actual realizable kit value. And on top of it, some of the existing products also are seeing some premiumization. Switches getting into haptics-based switches, or horns getting into sort of mechanical horns to electrical horns. LEDification for lamps has been a consistent journey for last few years, and we have been seeing that benefit out of it. Some of the sensor reduction is increasing. So, all in all, definitely we are very, very optimistic as we move forward.
Sunil, short conversation today, but thank you very much for joining in. We're just waiting and counting down to the RBI MPC. And before that, there's one story that we'd like to tell our viewers, because sources tell CNBC-TV18 that the India-US trade deal is unlikely to have any adverse impact on India's farm sector. This was a crucial point which led to the delay between, the agreement between India and US. So let's just get some clarity in. Abhimanyu joins in with more. Abhimanyu.
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers, since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
We're all waiting for that final signing and the details. But thank you, Abhimanyu, for sharing what you've picked up. Meanwhile, Commerce Minister Piyush Goyal had outlined the timeline of the deal and the way forward. Listen in.
हमारा पहला ट्रांच बायलैटरल ट्रेड एग्रीमेंट का लगभग तैयार हो गया है। हमारी उम्मीद है कि अगले 4-5 दिन में हम एक जॉइंट स्टेटमेंट यूनाइटेड स्टेट्स ऑफ अमेरिका और भारत के बीच में फाइनलाइज करके साइन कर देंगे। फॉर्मल एग्रीमेंट को मिड मार्च तक साइन करने का अंदाज़ा है, लेकिन 18% जो यूएस टैरिफ्स घटने हैं वो जॉइंट स्टेटमेंट अनाउंस होने के बाद एग्जीक्यूटिव ऑर्डर द्वारा यूनाइटेड स्टेट्स ऑफ अमेरिका कर देगा।
All right, well, time to slip into a short break. Up next, we begin our coverage of the RBI monetary policy, which is set to be announced at 10 a.m. We have a slew of economists, experts, who will be joining in ahead of the RBI governor's address. Stay with us.
Thank you. Welcome to our special coverage of the RBI monetary policy. The governor is set to announce it. The decision of the MPC at 10 a.m. and the street, according to our poll, is going with a pause, and we'll tell you why. Inflation is benign, growth is steady, and so the Reserve Bank's focus is now likely to be on ensuring that past rate cuts are transmitted smoothly through the economy while keeping the powder dry. And that's exactly what a poll is also signaling, with 90% expecting the MPC to hold rates in this policy despite having the room to cut. There's a very small minority that is still betting on a 25 basis point reduction, but keep in mind the number of people that was actually expecting a cut was a tad higher before the US trade deal was announced. Still in minority, but now the market believes the deal has eased the pressure on RBI to provide any immediate stimulus at the moment. Beyond this as well, 70% believe the RBI will continue to stay on pause through the entire calendar year. Barely a third are even penciling in one more 25 basis point rate cut, and nobody's talking about a hike in 2025. The focus is very much going to be on liquidity, whether that is through more OMOs, that is the wider call, longer dated VRR operations, which RBI has already been doing, or even an operation twist to manage the long-term yield. All of that is on the table. On the currency, don't expect much from RBI because they'll continue to reiterate the fact that stance being, not targeting any specific level. The 10-year yield, now that is seen settling by 40% below 6.7% or up to 6.8% by the end of March. And on the rupee, thanks to the trade deal and the recovery that we've seen, by March end, the levels are seen at 90 to the dollar. CPI and GDP don't expect much change simply because, the new base year revision is around the corner. So RBI will unlikely tinker with that. The economists, though, do see 20 to 50 basis point upside on the new range. So bottom line is neutral policy, wait and watch approach, less focus on rate action, more on liquidity management. Also joining me now is Prashant Nair. Prashant, pretty much a status quo. I think all markets want to hear is some amount of liquidity support.
Some amount of liquidity support, right? But in what way, Ritu? I mean, exactly in simple terms, right? So the RBI is basically, what are they expected to do? I mean, the rate thing is aside, but on liquidity management, I mean, in terms of how this impact, and I think the expectation from a equity point of view is that they'll perhaps do some more OMOs, etc., more liquidity, positive for financials. Is that likely?
Yeah, it is very likely. The broader consensus is perhaps around an OMO. CRR cut, there's a very small minority that is talking about it. It is unlikely. Last year, RBI already cut it from 4% to 3%. Unlikely that they'll bring it down any further. But whether they give banks some sort of relaxation on, the capital requirement, tweak the LCR rules, bring some leeway there, all of those are things that are on the table.
It was the policy before last when they announced those range of measures, right? I mean, not the last month, but the one before that.
Around the August or so, when, it was more of a banking policy, less on rates. Last policy, we had a 25 basis point rate cut, which surprised the street, which again tells us never second guess the RBI. We're going in with a pause, but we'll see what the governor announces at 10 a.m. Let's actually also bring in our guests to decode what to expect. We have Deutsche Bank's Kaushik Das, Standard Chartered Bank's Parul Mittal Sinha and Bajaj Finserv's Lakshmi Arre joining in now. Lakshmi, Parul, Kaushik, thanks very much for being here. Kaushik, let me quickly start with you. What is the base case scenario, and on liquidity, specifically 2 to 3 measures that could be on the table?
Hi, Ritu. I think you summarized it well, all the baseline expectations that you spoke about. So we are going with a pause at this stage, given that RBI has done quite a lot, 125 basis points rate cut. And as you mentioned, that after the US trade deal, expectations about the growth outlook has only improved. So over a period of time, you'll probably see FY27 growth forecast being increased, whether RBI does it today or waits till the new GDP data comes out and April they take a call. But the baseline expectation is that growth, the risk that was there, that has gone out with the UFTA and the India-US trade deal that has come in. On liquidity, RBI again has done a lot from December 5th policy till today. If you see the overnight market rates, it's at 5% now, close to the SDF rate. And a lot of liquidity now, the kind of system liquidity has gone to 5 lakh crore surplus. And that will help to bring short-term rates, which had gone up a little bit in the last few days, back to 5%. And if RBI doesn't suck out that liquidity in the next few weeks through VRRR, that can improve market sentiments. And all RBI needs to do is basically sound that they're not going to do anything immediately and maintain the status quo, and they're monitoring, and more or less, they're still in favor of transmission of the previous rate cuts to happen for the next several months without giving any fear of rate hikes, at least in 2026.
So basically a wait and watch kind of policy, right? I mean, let's let everything we've done work through the system and then take a call, right?
This is the one more thing which Ritu had asked. Now, whether RBI takes the opportunity to announce today, or given that we already have a lot of durable liquidity, whether they decide to postpone it and announce it as and when they feel the need. I think market is in a good place after the last few days, whether you short-term rates or the long-term rates, which have kind of corrected after the trade deal, and the rupee has also appreciated from 90.
Yeah. I mean, imagine if we were having this conversation last Friday.
Yes.
I mean, it would have been a completely different kind of picture, right? It's all changed, and that's how fast, financial markets and all this stuff is moving now, day on day. Let me get in Parul Mittal Sinha as well. Parul, morning. Lakshmi, morning. Parul, to you first. What's your sense? On rates, I guess consensus is no change, but on this liquidity bit, what will the RBI do?
Yes, so like everybody has been saying, status quo policy, no change in policy rates or even the stance, especially ahead of the new GDP and CPI series expected to be released in this month later on. On liquidity, I don't think the market is expecting additional OMO purchases or even a CRR cut kind of measures, because there is already ample liquidity in the interbank system, and overall core liquidity is quite high in response to the OMO purchases and buy-sell swaps done by RBI recently. In fact, market will look out for any indications of whether RBI will look to manage this liquidity by deploying instruments like VRRR, which will take away the liquidity in the shorter term to manage this imbalance, which is short-term imbalance from the excess liquidity.
But Parul, the question is more on also managing the yield curve. 6.7 kind of a yield, despite that 125 basis point rate cut coming in. Is an operation twist something that could be on the table, or what do you expect from RBI to manage that?
So, Ritu, I think right now we've seen a good tailwind from the India-US trade deal, and the market yields, which had really ratcheted higher out of fear and out of some negative sentiment, they have calmed down already. So we've seen almost a 15 basis points move lower in rates across all asset classes, be it bonds, be it OIS, be it FX forwards. So in this scenario, we don't expect RBI to deploy more tools from their toolkit to calm down the markets. In fact, given the large borrowing program for next fiscal year, it may be more prudent for RBI to reserve those tools to deploy if the rates start going higher again. Right now, a 6.6%, 6.6 to 6.7 on the 10-year yield is not a very high yield. I think if it maintains at these levels over the next few months, the market will be in a good place.
Okay, 6.65 is where we're at. Keep that level in mind as the RBI announces the policy. But Lakshmi, your quick thoughts as well. What is the base case scenario you're going with? And what will you want to hear from the governor?
Yeah, hi, morning, Ritu. So clearly, base case is certainly for a pause. We have seen quite a bit of rate actions in the past. Let that transmission happen fully through. And in a lighter vein, if that 10% minority that you just showed as part of the poll actually were to be true and we see a rate cut, there is a very bright chance that our central banker could get poached by the US because they need it more than we do. But that's in a more lighter vein. But seriously, I think markets are not expecting any rate action. But I would say more of LSD, which is liquidity stability and demand for the upcoming massive behemoth gross borrowing program, which has been listed for FY27. So I think that's going to be the critical thing. And of course, more of operational focus. So the kind of open market operations that we've done up until now, clearly yesterday, if you see the aggressive cutoff in the OMO, all that has clearly helped the bond yields. So I think stability on that front is what the markets will watch out for.
What about growth forecast, Lakshmi? You think we'll see a bump up?
Well, unlikely, but I think given the clarity on the tariff and the US trade that is, yet impending to be announced in terms of details, I think something that has to happen will happen post that and not really in anticipation. So very unlikely, super surprised if you see anything surprise, anything in terms of a bump up as far as GDP is concerned.
Mood has certainly got a bump up with everything which has happened last few days, notwithstanding, the global screen, which is, I think, looking a little shaky now. Parul, what do you think? Growth? They'll wait, or you think they perhaps revise it up a little bit?
I think in the commentary, they can mention that growth outlook has improved, but they will wait for the finer details of this trade deal to come out to give a final number on how high the growth outlook can go. Also because the GDP series also is expected to get revised.
I mean, there are many,
Lakshmi, just one thing in terms of the global screen, Lakshmi, is there one sharp takeaway? I mean, if you're the governor, if you're the RBI, everything which has happened, what do you there is so much. It's like missiles raining down from all directions, right? Is there one sharp? How do you distill it and use it in your policy? Or you just take note of everything and do your own thing?
I would say focus on stability. I think that is going to be operational focus. I think strategic pause and operational focus would be the mantra if I were the central banker.
Okay.
Lakshmi, are you factoring in any kind of, banking measures, whether that is that ECB relaxations that were announced last year, for that to be implemented, any leeway on LCR? Will any of that help banks, and are you expecting that in this policy?
Lakshmi, that's for you.
Okay, sorry, I missed that. So I'd say that none of those, in incremental terms is something that we would expect today, but clearly taking cognizance of what has happened in the past. And let's not forget that, unlike equities, which has just started this month, every month on month, we've been seeing positive net flows by FPIs. So I think that's a definitely positive factor for the markets.
Kaushik, we just have a minute or so to go on growth. Don't you think RBI may just leave it be, given the new series that is around the corner? And also from MOSPI, we already have the 7.4% number. My sense is they will just leave it at that and not even bring it up. Now, the next focus will be FY27. Kaushik, quick read on what do you think they'll do on the macro numbers?
RBI will talk about 7.4 for this year. They'll not give any new forecast.
Yeah.
What is more important is forward-looking, because monetary policy is always forward-looking. So over there, the economic survey has already given 6.8 to 7.2. And recently, the said that we could even get 7.4 next year, just like this year. So, if you think about it, if RBI talks about a higher growth forecast in this policy, and at the same time, the inflation forecast is not revised down for next year, that could then come as a hawkish signal. Then, market will say then going forward, you don't need to do anything. And beyond that, the next move, whenever it is, should be a hike and not a cut. So if RBI is too bullish on growth, that can actually, hurt bond market sentiments in a negative way. So let's see what RBI does. But the risk is that growth is going to be, forecasted higher than what RBI.
The risk is that the growth is going to... Okay, all right. We don't have to wait very long. I think the governor is making an appearance on your screens now, and let's cut across.
And have already witnessed momentous actions on the geopolitical
Risk is a revision because
fronts. Amidst heightened geopolitical tensions and elevated uncertainty, the Indian economy is in a good spot with strong growth and low inflation. Inflation remains below the tolerance band and its outlook continues to be benign. High-frequency indicators suggest continuation of the strong growth momentum in Q3 this year and beyond. With the signing of a landmark trade deal with the European Union and the US trade agreement in sight, growth momentum is likely to be sustained for a longer period. Global growth, supported by tech investments, accommodative financial conditions, and large-scale fiscal stimulus, is expected to be marginally stronger this year than projected earlier. However, the confluence of escalating geopolitical frictions and rising trade tensions is unraveling the existing world economic order. Inflation outcomes are heterogeneous across jurisdictions, remaining above target in most advanced economies, prompting divergence in monetary policy actions as central banks near the end of their current easing cycles. Against a global backdrop that has increasingly become more cautious, bond market sentiments remain bearish, reflecting fiscal sustainability concerns. However, equity markets driven by tech stocks remain upbeat. The Monetary Policy Committee met on 4th, 5th, and today to deliberate and decide on the policy repo rate after a detailed assessment of the evolving macroeconomic conditions and the economic outlook. The MPC voted unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the MPC's decisions. The MPC noted that since the last policy meeting, external headwinds have intensified. Though the successful completion of trade deals augurs well for the economic outlook. Overall, the near-term domestic inflation and growth outlook remain positive. Headline inflation during November and December remained below the tolerance band of the inflation target. The revised outlook for CPI inflation in Q1 and Q2 of next year at 4% and 4.2%, respectively, revised slightly upwards, continues to be benign and near the inflation target. The slight upward revision in the inflation outlook is primarily due to increase in prices of precious metals, which contribute about 60 to 70 basis points. The underlying inflation continues to be low. On the growth front, economic activity remains resilient. The first advanced estimates suggest continuing growth momentum, driven by domestic factors amidst a challenging external environment. The growth outlook too remains favorable. Based on a comprehensive review of the domestic macroeconomic conditions and the outlook, the MPC therefore was of the view that the current policy rate is appropriate, and accordingly it voted to continue with the existing policy rate. It also agreed to retain the neutral stance. Going forward, the MPC will be guided by the evolving macroeconomic conditions and the outlook based on the data from the new series in charting out the future course of monetary policy action. You are all aware that in a few days we will have a new series for both GDP as well as inflation. I will now dwell on the assessment of growth and inflation. First, growth. The Indian economy continues on a steady improving trajectory, with real GDP poised to register significant higher growth of 7.4% this year as compared to the previous year. Amidst global headwinds, private consumption and fixed investment both supported growth. Net external demand, however, remained a drag, with imports outpacing exports. On the supply side, growth in real GVA on the back of a strong contribution from the services sector and revival in manufacturing activity is estimated at 7.3% this year. Going forward, economic activity is expected to hold up well in the next year. Agricultural activity will be supported by healthy, robust rabi sowing and improvement in crop vegetation conditions. Improving corporate sector performance and sustained momentum in informal sector should boost manufacturing activity. Construction sector growth is expected to remain firm. Services sector should continue to be resilient with strengthening domestic demand. Early results from IT firms suggest an improvement in business activity. On the demand side, the momentum in private consumption is expected to sustain next year. Rural demand remains steady with improving agricultural activity and rural labor market conditions. Recovery in urban consumption should further strengthen with continued support from GST rationalization and monetary easing, among others. High capacity utilization, accelerating bank credit, conducive financial conditions, and government's continued emphasis on infrastructure should give an impetus to investment activity. Moreover, several measures announced in the budget should be conducive for growth. You are all aware that one of the kartavs, one of the pillars in the budget has been on sustaining growth. The recently concluded India-EU FTA and the prospective India-US trade deal, along with several other trade agreements, will support exports over the medium term. Services exports should remain resilient. The spillovers emanating from geopolitical tensions, volatility in international financial markets, and shifting trade patterns pose risks in the outlook. Taking all these factors into consideration, real GDP growth projections for Q1 and Q2 of next year, that is 2026-27, are revised upwards slightly to 6.9% and 7% respectively. The risks are evenly balanced. I may mention that we are deferring the projections for the full year to the April policy, as the new GDP series will be released later in the month. I now come to inflation. Headline CPI inflation remained low in November and December, even as it firmed up by 1 percentage point in these 2 months. This increase was largely driven by the lower rate of deflation in the food group. Excluding gold, core inflation remained stable at 2.6% in December. Near-term outlook suggests that food supply prospects remain bright on the back of healthy kharif production, sufficient buffer stocks of food grains, favorable rabi sowing, and adequate reservoir levels. Core inflation, barring potential volatility induced by prices of precious metals is expected to be range-bound. Geopolitical uncertainty, coupled with volatility in energy prices and adverse weather events, pose upside risks to inflation. In terms of the headline inflation trajectory, despite the anticipated momentum being muted, unfavorable base effects stemming from large decline in prices observed during Q4 of last year, that is 2024-25, would lead to an uptick in year-on-year inflation in Q4 this year. Considering all these factors, CPI inflation for this year, the current year 2025-26, is now projected at 2.1%, with Q4 at 3.2%. CPI inflation for Q1 and Q2 next year are projected at 4% and 4.2% respectively. Excluding precious metals, the underlying inflation pressures remain muted. The risks are evenly balanced. Again, in view of the impending release of the new CPI series on February 12, as I mentioned for growth, we will be presenting our CPI inflation projections for the full year 2026-27 in our next policy statement in April. I will now be talking about the external sector. Despite heightened uncertainty, global trade remained relatively robust. India's merchandise exports, supported by trade diversification efforts, grew by 1.9% year-on-year in Q3 25-26. Merchandise imports grew by 7.9% during the same period, resulting in a widening of the trade deficit. Robust services exports and healthy inward remittance receipts would, however, keep India's current account deficit for the current year moderate and sustainable. Moreover, India's proactive efforts in pursuing bilateral and regional trade agreements with major trading partners are expected to boost international trade and investment, diversify trading partners, and integrate India into global value chains. Even on the external financing side, gross FDI to India increased at a robust pace during April to November 2025, for which we have data till now. Net FDI too increased as repatriations declined despite a rise in outward FDI. India continues to remain an attractive FDI destination for greenfield projects, as evidenced by a number of announcements made in this regard. However, FPI recorded net outflows of $5.8 billion till February 3 this year. As on 30th January 2026, India's foreign exchange reserves stood at a very healthy $723.8 billion, providing a merchandise import cover of more than 11 months. Overall, India's external sector remains resilient. We are very confident of meeting our external financing requirements comfortably. Now I'll be speaking about the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, which is the Liquidity Adjustment Facility, stood at a surplus of 70,000 crore on a daily average basis since the last MPC meeting in December 2025. There has, however, been an uptick, I may mention, in February, and now it is almost 2 lakh crore rupees. The Reserve Bank undertook several measures to provide durable liquidity in December and January. Based on assessment of systemic liquidity and its outlook, we announced and undertook further durable liquidity augmenting measures in the second half of January and February 2026. In response to the cumulative 125 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks has declined over this period till December, for which we have data till now, by about 105 basis points. I may mention that the interest rate effect is 94 basis points. Similarly, the weighted average domestic term deposit rate on an average on fresh deposits declined by 95 basis points. This decrease on an outstanding deposit basis is 41 basis points over the same period. Coming to money markets, especially for CPs and CDs, that is commercial papers and certificates of deposits, the rates tightened in January 2026 after softening till December as a result of moderation, as a result of various factors, including moderation in surplus liquidity, excess supply from bunching of redemptions in CPs and CDs in January, and then there is always the year-end effect in the last quarter of the year. G-Sec yields mirroring global trends have continued to harden over the last 8 months due to a host of factors. Going ahead, the Reserve Bank will remain proactive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy and to facilitate monetary policy transmission. Liquidity management would be preemptive, with sufficient allowance for unanticipated fluctuations in government balances, changes in currency in circulation, and forex intervention, etc. I'll now talk about financial stability. The system-level financial stability parameters related to capital adequacy, liquidity, asset quality, and profitability of scheduled commercial banks continue to remain robust. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital position and improved asset quality. As per latest available data, credit from all sources, it has picked up. It grew at 13.8% as compared to 11.6%. A year ago, it had even come down to 9% in May. Bank credit too recorded an uptick in recent months. This growth is supported by sustained lending to all sectors, particularly retail, services, and MSMEs. Large industries also recorded higher credit growth. Now, as has been the practice, I shall be announcing several measures which aim broadly to enhance, number 1, customer protection, number 2, advance financial inclusion, 3, enhance the flow of credit, 4, strengthen the UCBs, promote ease of doing business, especially for NBFCs, and deepen the financial markets. For customer protection, we will issue 3 draft guidelines. 1 related to mis-selling. This has been in the works for some time. 2 regarding recovery of loans and engagement of recovery agents. 3 on limiting liability of customers in unauthorized electronic banking transactions. It is also proposed to introduce a framework to compensate customers up to an amount of 25,000 for losses incurred in small value fraudulent transactions. You are all aware that there has been a number of fraudulent transactions for which RBI has taken a number of measures, and we will again in this regard we also now wish to publish a discussion paper on possible measures to enhance the safety of digital payments Such measures may include lagged credits and additional authentication for specific classes of users like senior citizens. In the financial inclusion space, we have comprehensively reviewed 3 schemes: the lead bank scheme, the Kisan credit card scheme, and the business correspondent model. We shall issue draft revised guidelines with respect to each one of them. It is also proposed to launch a unified portal for better management of the lead bank scheme data. The limit of 10 lakh rupees for collateral-free loans to MSMEs is proposed to be increased to 20 lakh rupees. This limit has been there for quite some time. Coming to the real estate sector, to further promote financing to real estate sector, it is proposed to allow banks to lend to REITs with certain prudential safeguards. I may mention that lending to InvITs, which are similar in structure to REITs, is already allowed. Now I have 4 measures for the urban cooperative banks. They are an important link in our financial inclusion effort. The first 2 pertain to raising the financial limits on unsecured loans and loans to nominal members by the UCBs. We also propose to remove the tenor and moratorium related requirements on housing loans given by Tier 3 and Tier 4 UCBs. Then, to strengthen the managerial and technical capacity of the UCBs, we shall launch a mission which we call Saksham, which stands for Sahakari Bank Kshamata Nirman. This mission intends to train over 1,40,000 participants, officials, members, directors from the UCBs. I now come to NBFCs. There are 2 measures for them. NBFCs having no access to public funds and having no customer interface with an asset size not exceeding 1,000 crore rupees are proposed to be exempted from the requirement of registration with the Reserve Bank. Moreover, it is proposed to dispense with the requirement for certain NBFCs to obtain prior approval to open more than 1,000 branches. Coming to financial markets, you are aware we had earlier issued revised draft regulations for ECBs, that is external commercial borrowings. These regulations have been finalized. They shall be issued shortly. We also propose to remove the limit of 2.5 lakh crore rupees for investments under the voluntary retention route. Investment through this route, that is the voluntary retention route, in each category of securities, central government securities, state government securities, corporate bonds, will be subject to the investment ceiling for the respective category under the general route. Furthermore, in pursuance of the announcement made by the Finance Minister in the Union Budget of 2026-27, we propose to issue the regulatory framework for derivatives on corporate bond indices and total return swaps on corporate bonds. It is also proposed to issue draft revised guidelines for authorized dealer banks and standalone primary dealers, allowing them more flexibility in undertaking foreign exchange transactions. Now, before I conclude, I would like to inform that Reserve Bank observes the Financial Literacy Week every year on specific themes of financial education. The campaign this year will be launched on 9th February, Monday, coming week. In continuation of our ongoing endeavor on re-KYC of bank accounts, you are aware that we had launched a campaign for re-KYC and financial inclusion earlier this financial year. The theme that we have chosen for this year's Financial Literacy Week is KYC, your first step to safe banking. I urge all banks as well as participants to actively take part in this campaign. To conclude, the Indian economy continues to register high growth despite a challenging external environment clouded by geopolitical uncertainties. Benign inflation provides the leeway to remain growth supportive while preserving financial stability. We remain committed to meet the productive requirements of the economy and sustain the growth momentum. Thank you, Namaskar, and Jai Hind.
That is the Reserve Bank of India, as expected, not changing rates. It is a unanimous, decision by the MPC to leave the repo rate at 5.25%. The stance unchanged at neutral, but as far as the macro forecast is concerned, there have been some tweaks, although RBI refrained from giving out any forecast for the full FY27, either on GDP or CPI, on account of the revision, the revision that is expected with the new base series getting changed in the coming days. So as far as CPI is concerned, for the current year, there's been a 10 basis point upward revision. It was earlier 2%. Now it is 2.1%. And for the next 3 quarters, that is Q4 onwards, there has been an upward revision in the CPI numbers. So what was 2.9% for the fourth quarter is now seen at 3.2%. What was 3.9% for the first quarter of the next fiscal is now 4%. And what was 4% for the second quarter is now seen at 4.2%. On growth as well, as expected, RBI for FY26 has left it at the number that we got from the economic survey, and the first advance estimate, 7.4%, is the growth number for the full year. For FY27, we only have the first half numbers, and that is 6.9%, an upward revision from 6.7% below. And Q2 is seen as 7%, which is again an upward revision of 20 basis point. On liquidity, I think that is going to be the big disappointment. Not much said by the RBI governor, no mention of OMOs, only that they will continue to keep it comfortable with various measures as and when needed.
I think that some of the stuff, it's basically it's absolutely as we discussed earlier, nothing at all. And towards the end, there was a few announcements with regards to NBFCs, bank branches, etc., etc. Housing loan, there was something, etc.
For urban cooperative banks.
Urban cooperative banks. So I think it's banking and more kind of sort of that kind of policy in terms of look at the market reaction. Nothing. Yields have not moved. Markets have not moved. Bank Nifty has not moved. We have SBI's Ashwini Kumar Tiwari with us. We also, of course, have our economists Kaushik Das and Upasana Bharadwaj. We also have Shobit Mehrotra with us. Thank you all for joining us. Ashwini ji, if I can come to you to begin with, Prashant here. Highlights according to you, sir, from the policy.
So the rush at the end, as you rightly mentioned, is something we are still absorbing. Those were the highlights. There was no change in the policy as we expected. So therefore, the announcements on banking, which is customer protection, financial inclusion, the raising of the ceiling of the MSME collateral-free loans, and of course, we are expecting the final ECB guidelines. So quite a lot of announcements towards the end. And we haven't had time to go through all of them in the detail. We will wait for the more details to emerge. But I think the focus, both of the government through the budget and of the RBI, is to push growth. And you are aware of the budget announcement of the Committee on Banking. So we will wait for those terms of reference. And I think there's a lot of focus on growth, having sorted out the FTA and the US-India trade deal. The focus comes back to growth, and banks have to play an important role in that.
Tiwari, just from what you've heard, and you said you will need to absorb it in terms of the exact specifics, but doesn't look, this is all, of course, aimed at more liquidity transmission and more credit in the system, as you said, but doesn't seem like an outsized impact in that sense, right? For any segment of the, be it NBFCs or banks, right?
Yeah, no outsized impact. But I think the most important and the best policies, which is slightly boring, which is continues on a regular path, which gives consistency.